Hello everyone, and welcome to our next video, Understanding the Bond Market, a Beginner's Guide. I'm your host, Jonathan Garber, and today we're diving into the fundamentals of the bond market. First things first, what exactly are bonds? Well, unlike equity securities like stocks, bonds are known as debt securities. When you invest in a bond, you're essentially lending money to an entity, whether it's a municipality, the US government, or a corporation. It's a bit different from stocks, where you actually own a piece of a company. With bonds, you're a creditor holding a promise for repayment. Bonds come in all shapes and sizes. There are municipal bonds tied to local projects, corporate bonds supporting businesses, and Treasury bonds issued by the US government. Each serves a unique purpose, offering varying risk and return profiles. One key characteristic of bonds is that they're a fixed income security. This means you receive regular interest payments, providing a stable income stream. These are best for somebody seeking an investment that carries lower risk with an opportunity to earn a more stable return on investment. Next, let's discuss some of the infrastructure shaping the bond market. Unlike the bustling floors of stock exchanges, the bond market operates in a decentralized network of broker-dealers. These financial intermediaries connect buyers with sellers, making transactions possible. Some of the most well-known broker-dealers in the bond market include JP Citigroup, and Goldman Sachs. For the most part, the bond market relies on over-the-counter trading. Unlike stocks, which are more often traded on centralized exchanges, bonds change hands directly between parties. And this flexibility allows for a more tailored approach to transactions. In the digital age, much of the bond market's operations happen electronically. This not only streamlines transactions, but also enhances accessibility, which creates a broader access to the market. So, who is making an investment in the bond market? Well, first, we have individual investors, the backbone of the bond market. Everyday people seeking stability and a steady income stream often turn to bonds. Municipal bonds, corporate bonds, or government bonds, individual investors find their niche, contributing to the vibrancy of the market. Next on the list, we have institutional investors. Think pension funds, insurance companies, and endowments. These larger institutional investors bring substantial capital to the table, strategically allocating funds across different types of bonds to balance risk and ensure long-term financial health. Last on the list, we have central banks. These are the most powerful investors. In the United States, the Federal Reserve serves as our central bank, and they play a pivotal role in the bond market. Central banks engage in bond investments as part of their monetary policy, influencing interest rates in their attempt to foster economic stability on a grand scale. So, as we wrap up our journey through the basics of the bond market, let's review some of the key concepts discussed in today's video. We covered what bonds are and explored the different types, from municipal to corporate to government bonds, and discussed some of the key players, including broker-dealers like JP Citigroup, and Goldman Sachs. We also recognize the diverse array of investors contributing to the vibrancy of the bond market, from individual investors seeking stability to institutional investors strategically navigating risk, and central banks steering economic currents. Each participant plays a crucial role in this financial ecosystem. Again, my goal is that you learn something new in every video. And remember, the journey doesn't end here. There's always more to explore in the world of finance. So if you found this video enlightening, don't forget to like, share, and subscribe for additional videos. I hope you have a great day, and thank you for joining me today.